Okay. Welcome everyone to this Bruegel event on global growth. My name is Nicolas Potier. I'm a research fellow here at Bruegel. Very, very glad here to have you, the audience that is here in person, but also online to join on this important event. I think, especially here in Europe, we're all a bit concerned about our growth performance these days. We have a bit of soul searching, given that we've been being a bit disappointed with how growth has performed the last years. We see all the challenges that we have in front of us and maybe the lack of fiscal capacity, and there's a lot of debate about how we can change that. In some way, this also mirrors a global picture where growth has become a bit more subdued. And for all these reasons, we are really delighted to have this excellent panel here today, and especially Nanlin from the IMF, who is their deputy chief, division chief at the research department, who has written an excellent chapter in the World Economic Outlook on exactly this question, on the role that productivity played in the growth slowdown across the world, but especially also, in our interest also in Europe. And to join me in discussing this chapter and exploring the ideas in this chapter, I have Jochen Schanz, who is a senior economist at the EIB. Before he was at the EIB, he was at the Bank of England in the BIS, and he's working on different topics of economic growth, cohesion, especially the things that we're interested here in this talk. And I have Reinhard Falke. He is the director for policy coordination at DG ECFIN. He had a prestigious career at the European Commission, but also he worked at the German government on these kind of questions. He's interested in growth forecasting and all kinds of these kind of economic core topics. We're happy to have him as well. So to not further ado, so we have enough time for debate, I give the floor to Nan so she can give us the presentation of the VEO outlook.
Thank you, Nicholas. And first, I want to extend my gratitude to Bruegel for organizing this event and give us this opportunity to exchange ideas and insights. And thanks everyone for being here. If we can pull out the slides, it would be great. Okay, so I'm going to give you a very brief overview today about this chapter 3 in our April 2024 World Economic Outlook on slowdown in global medium-term growth. And we will ask, what will it take to turn the tide? Okay, so this chapter is motivated by this observation. When we look at forecasters' medium-term projections, we see they have been consistently downward adjusting their projection for the 5-year ahead GDP growth. If you look at the blue line, that is the forecast made by economists in IMF, it peaked at 4.9% back in 2008 when they project for 2013, to now the latest projection for 2029 is at only 3.1%. And this is not just limited to forecasters in the IMF. If you look at the red line, which is surveyed by Consensus Economics, the forecasters from other institutions also similarly revised down their projections. The right-hand side chart shows you this phenomenon is also quite widespread. About more than 80% of the economies in the world are expecting to slow down their medium-term growth. And this includes some of the really large economies, both for advanced economies and the emerging markets. So in this chapter, we asked 3 questions. First, how did we get here? And then, where is growth heading in the medium term? So what is the likely trajectory of medium-term growth given the forecastable demographic trend and the prevailing forces such as emergence of artificial intelligence, very high public debt level, and geoeconomic fragmentations? And the third, we want to know what are our policy options that can help us elevate growth back to the pre-pandemic higher level. So first, how did we get here? Starting from a very textbook approach, doing a solo kind of a growth accounting decomposition, we can look at the approximate drivers of growth in terms of capital, labor, and total factor productivity. So here you will see global growth peaked prior to the global financial crisis and then declined ever since. So the decline is about 1.8% globally. And among this 1.8%, 1% can be accounted by total factor productivity slowdown. So that is more than half. And all the other components, labor and capital, also have declined. For the advanced economies, this decline happened much earlier, actually at the beginning of 2000s. For emerging market developing countries, this growth pattern actually mirrors the increase and then slowdown of globalization. All right, so since I mentioned TFP is the component that contributed the most, in this chapter we want to understand a little bit better what is the driving force. Generally speaking, TFP growth can be driven by two components. One is innovation. You can think about it as technological progress or better business practices so we can do things faster and better. The second component is what we call allocative efficiency. So that is given within firm productivity if it's not changed, but you just increasingly move resources, capital and labor to more productive firm, then for the economy at aggregate, you will benefit from this higher allocative efficiency and higher productivity growth. So this chapter is going to use this well-known approach by Xi and Clino, pioneered by those people, and then also correct for some measurement error using the more advanced methodological innovation. We use the firm level data for 20 countries that include 15 advanced economies and emerging markets. And then when we measured at the sector level and then aggregate up using sectoral GDP share to look at country level allocated efficiency changes. So the very striking observation here is that there is a very large annual TFP growth drag from declining allocated efficiency for most of the countries in the sample. And to give you a sense of the magnitude, for medium advanced economies, the drag is about negative 0.5%, and considering the TFP growth, the actual TFP growth during the same sample period was only 0.5%, that means if misallocation had not increased, we could have had doubled the TFP growth. Okay, sorry, click too much. Okay, so what explains this increasing misallocation? It can come from either the within sector firms misallocation just getting worse, or economy is increasingly concentrating in sectors that are already misallocated, so there's composition effect. So to understand which one is the main explanation, we did this decomposition and we see that it's really the within sector misallocation that account for most of the change in allocated efficiency. But for some countries like China, this compositional change also matters, and that is because for services allocated efficiency just inherently lower than goods. So when an economy transforms by moving from manufacturing to services, its aggregate allocated efficiency deteriorates. Now within sector, what happened is we see during this sample period, which is from 2000 to 2019, there is an increasing uneven firm real productivity growth. So what happened when you have uneven firm growth, ideally you want resources to move to the more productive firm. But because in reality, in practice, there are all kinds of adjustment frictions, these movements usually takes a very long time. So in the short run, it appears as increasing misallocation. So you can think about it as some kind of byproduct of creative destruction. So you move 2 steps forward with your innovation, and you have to move one step backward because of misallocation, but in that, you still move forward by 1 step. So that means part of this misallocation increase is transitory, but it is so slow, and we estimate it's about 10 years for the misallocation to revert back to its long-run structural level. And that is because, firm with time, they will naturally scale up and down according to their productivity level. So misallocation generally self-corrects. But because if it's slow, we will have a misallocation in the short run. Okay, so I mentioned there is this structural allocated efficiency. And what we're thinking is maybe policy can do something about this structural component of allocated efficiency. And when we look at the data, it's pretty apparent that high allocative efficiency seems to be associated with lower product market barriers and more trade and the financial openness and the less friction in the labor market. So there are structural characteristics of economy that can give you higher allocated efficiency. And if we do a thought experiment simply by closing the gap of the countries whose structural indicators below US, which is the frontier, by 15% over 10 years, that can already give you a huge boost to global growth, about 0.7 percentage point. Okay, so the next is the demographic. And here I just want to highlight, in fact, 90% of the world economies are going through or have already gone through this transition. Now we're looking at 2021 compared to 2008. The working age population has been much lower now than before, and that is because fertility rate has decreased and population has been aging. So with that, working age population is shrinking, but it also has impact on labor force participation rate. When we look at the last 15 years, in fact, labor force participation rates indeed have declined. That is indicated by the black dots in the chart. And most of it is explained by the yellow component, which is the aging effect. And it's because older workers just naturally less active in the labor force. What is interesting is in advanced economies, except for United States, you do see the increasing labor force participation from women actually offsets this aging effect. Unfortunately, there is also retraction of labor force participation in men, particularly in some emerging market developing countries and the United States. The last component is investment, and here we saw investment decreased during the global financial crisis. And after 15 years, it still has not recovered. And in fact, it's still 40% below the pre-global financial crisis trend. And in our analysis, we find part of it, about half of it can be explained simply by weakness in economic activity. So this is about firms seeing economic growth slow down or expecting economic slowing down, and they're less likely, they know they will have less sales, so they're less likely to make investments. When we look at the firm level evidence, we have data from about 45 countries with the firm level information. We see it also has something to do with deterioration of Tobin's Q, which is the indicator of firms' profitability or future productivity relative to the cost of capital. It also has something to do with firms' leverage and uncertainty. Increasing uncertainty also help to explain the deterioration of investment. Okay, so let me go to where is growth heading, and I'm going to skip the methodology part and just want to point out our finding here. When we look at the medium-term growth in this chapter, we're thinking about the end of the decade, so in 2030. So in 2030, when we put all three components, productivity, labor, and capital together, we're looking at a global growth rate of 2.8%. And put into a historical context, the 2 decades before the pandemic, that is from 2000 to 2019, the average annual growth rate is 3.8%. So there is a big gap of 1%. And big chunk of it comes from the much slower labor growth because of the aging, because of the labor force participation rate is going to deteriorate associated with aging. Total factor productivity is also going to decrease. Some of it is related to ideas are getting harder to get, so the research productivity has deteriorated. And also the number of researchers have been also slowing down. There is also the convergence effect on productivity and also stagnation of human capital. When we look at education attainment data, that seems to point to that trend. So putting this together, we're looking at a shortfall of 1 percentage point compared to the historical average. So now the next question is, this is a baseline scenario. By baseline, we mean there is no additional shock, there is no policy changes. So the next question is, what can policies do? What are the policy maybe most effective in elevating growth? And also we are facing a bunch of tailwinds and headwinds, so there's huge uncertainty around this point estimate as well. So when we think about those tailwinds and headwinds, what is likely their impact? And I will not get into details considering the time. We can probably also discuss this during the panel. Here, just want to point out, when we consider policies, we're thinking about policy that can increase labor force participation, policy that can address the misallocation that I just discussed, and the policy that improve talent allocation. And here, by talent allocation, we mean jobs are increasingly filled by talents and a comparative advantage, not by social norms or discrimination. So when we look across the board of those 3 different policy areas, we saw the biggest gain can come from the structural reform addressing misallocation. And when we look at headwinds and tailwinds, we also see we can get a significant boost from AI. But of course, there is also huge uncertainty here, depending on what the technology, the speed of technology, adaptation, and whether this technology is complementing labor or replacing labor. Okay, so let me just conclude quickly the key finding. We saw a steady decline in both expected growth and actual growth, and TFP accounted for bulk of this decline. And among the TFP growth, a lot of it can be explained by increasing misallocation in labor and capital between firms. Population aging has and will continue to exert a drag on labor force growth, and weak capital formation partly reflect weak overall growth. If we assume there's no major policy change or shocks, by the end of the decade, global growth is likely to fall by 1 percentage point below its pre-pandemic average. But I want to end this with a positive message here. There are policies we can adopt, but those are rather ambitious policies that need to be put in place quickly. And if we can have some help from the possible tailwinds, it is likely we can close the growth gap. Thank you. Let me stop there.
Thanks a lot. Really fascinating work, and ambition is really what I think we should strive here to find out what is realistic, what we can do here. Before we get into the policy discussion, this is, I think, for every economist that worked on productivity, it's very difficult. So the more impressive the work you've done here. So maybe before we go to more in the kind of overarching level, what are some difficulties that you encountered and how you overcome them, and what are caveats where you think these are conclusions people should not jump to based on the findings that you have?
Well, I can talk a lot about many hours about the difficulties, and of course, I think trying to measure productivity correctly, measure capital correctly is very challenging, right? Especially now, capital has a big component of intangible capital, R&D, marketing and design that is not very observable. For total factor productivity at the aggregate level, we know it's a solo residual, so it's kind of take over everything. But I think the one advantage in this chapter and also direction I think we are going into with our analysis is trying to utilize firm level data that we can have better sense of what is really going on the ground and have a better identification, trying to understand the causality to tell the story.
Okay, perfect. Thanks a lot. So before we go to our panelists, just a reminder for our audience. So those of you that here in the room, we will give you the opportunity to ask questions in person. But for those of you that are joining us online, we have, as always, a Slido for this session. So you will be able to post questions here. The hashtag for this event today is global growth at slido.do or slido.com. Now let me give the floor to Reinhard. Please give us your thoughts on this chapter. What's pointed out to you, or what were you thinking reading this?
Thanks a lot, Nicola, and thanks a lot for having me here. And let me start by congratulating you and your team, Nan, for this really fascinating work. I mean, you're giving a broad brush to global growth challenges, and they, as Nicola said at the beginning, they resonate with our policy agenda here in Europe quite a bit. I wanted to share a few complementary remarks on the diagnosis through a European lens, and then also share some policy implications in essentially three policy areas that I think are important. I mean, there is much positive that could be said about the European economy at this juncture. Resilience in face of unprecedented shocks over the past couple of years. Overall, no signs of scarring from this. I mean, this is something that we had feared a lot in 2020-21. We experienced record labor markets with unemployment rates low as never been before. More importantly, employment very high. And also participation rates are increasing to unprecedented levels, which is helping some of the elements, but I will come back to that in a second. Last year, even though growth was broadly stagnant in Europe, 2 million jobs were added to the pay bill. All of this is also helped by a recovery and resilience facility, so an unprecedented financial support instrument that keeps public investment holding up quite well. So all in all, we're in the middle of finalizing the numbers for our spring forecast next week. Europe is, returning to growth. It's not going to be stellar, but it's there. But obviously, there are longer-term challenges that had been there already before COVID struck. And on productivity is one of that. I mean, lower total factor productivity compared to the US is a secular phenomenon that we have. 20 years ago, we were seeing annual growth rates of total factor productivity around 1.3. Now we're down to about a half. Again, looking at the latest numbers, it may look a little bit better, but not stellar. One reason that we find in our analysis is that, particularly in the comparison with the US, is that the sectors that are basically seeing faster productivity growth, particularly the ITC sector in the US, it's a bigger chunk of the US economy compared to the EU, whereas our sectors that are very important are in more conventional manufacturing. So that's part of the explanation. On R&D spending, I mean, an important element on a driver of productivity and total factor productivity, we're still away from our own target of 3% of GDP. Some countries are closer, some less, but still a far shot from some of the important competitors, and a particular difference between relatively poor performance of the private sector in terms of R&D. We have also, this is something that I was on our side that we're finding in the analysis, is that the diffusion of innovation, of new innovation in the economy has slowed down over past decades. That's an area that we do not necessarily fully understand, but that's important. The question is to what extent perhaps the digital economy is having a role into that, where data is playing a bigger role, which make it harder for innovation here to move across the economy. On education, that's the last point I want to flag on the diagnosis. I mean, overall levels have improved and are not so bad. On the other hand, there is lack of excellence, particularly in those science areas that also seem to count a lot when it comes to frontier developments of the future. And then, of course, there has been a couple of weeks ago a big wake-up call on basic education with the PISA results that basically show that quite a number of European member states saw their results tumbling. Now, quickly to policy implications, I think in order to structure a little bit our thinking, I think it's important to think of markets, of knowledge, and of financing. And I'm flagging this here also in the context of the EU, where much of the policies levers are in the hands of member states. But at the same time, being bound together in a European Union and in a single market, we need a coordination of policies, of member state action and EU action. So on the market, there is a huge asset with a single market with 450 million citizens, a great potential to increase scale, to improve allocation efficiency and competition by removing barriers to integration, but also to move beyond what we currently have. I mean, there's a long deplored lack of integration in the services market, but we have to move much further beyond. I mean, energy obviously is an important element also to drive productivity development. Some progress on energy union would be pivotal in order to make inroads on that area. So, and obviously we've seen last week or the week before the publication of the Letta report, which sets out a whole agenda, and that's relevant. Knowledge is the second element. I mean, obviously, and here just very briefly, increasing incentives for R&D in the private sector will be key in my view. We also need to attract talent to Europe. But that inevitably requires also attractive integration of talent and people coming to Europe. And final point here on this, I mean, we urgently need to reverse the deteriorating trend in basic education. I mean, if this is these are slow-moving developments. So if our diagnosis now indicates problems at that level, means that we have challenges for quite some time. And reversing these trends will also take time. The final point on financing, and I will be very quick on that. I mean, obviously, we're in a situation in the EU where we have the benefit of huge savings, but a very poor investment rate. So a very simple capital deepening already requires more momentum on investment. That means you have to continue to work on improving the business environment, and to make sure that there are reliable incentives for the private sector to invest. This is something to do also with our framework for decarbonization and the Green Deal. This has to be reliable in order to be there as an incentive and orientation for investment. And much more, we also have to leverage the market financing. And here again, I mean, this ties back to the market dimension. Progress in capital market union has been deplorably absent over the past 10 years. It has now moved back very prominently on the policy agenda. But this is, in my view, one of the pivotal elements, obviously. And the last element in all of this is there is obviously a lot of European investment to be done that has the nature of European public goods. I'm speaking about infrastructure in the cross-border nature, related to making the energy union a reality in the future. Revamping renewable energy requires cross-border grids across Europe, and we need to make sure that the financing of this is not falls victim to the different and sometimes fragmented fiscal space that member states are having. So there was a discussion how to finance some of that also at the European level. Obviously, this is a huge agenda carved out here for the new legislative period. I would stop here, but it's a great impulse and contribution of your work to this agenda. Thanks.
Thanks a lot, Reinhard. Let me have one follow-up question. A lot of the things that you talked about are, in a way, pleasant things. But there are also some unpleasant things, which would basically bring us to the theory of creative destruction. So we saw drivers of the decline in productivity in the report was misallocation of labor and capital. So you mentioned resilience of the European economy. Has this maybe been bought at the price of not letting enough companies go that might not have should have survived? Did we overshoot the target?
I think that's an important question, and perhaps first let's recapitulate the facts. I mean, when COVID struck, there was a huge concern about large waves of insolvencies, which did not happen thanks to very deft and committed policy intervention with guarantees and so forth. And basically also the introduction of outright moratoria on insolvencies. So we have seen quite a natural drop in the insolvency rate in 2020, 21, 22. Now, what we see now over the last 2 years or so, we have seen quite an important increase, which is, in my view, basically a resumption to something that's totally normal. We have more of country-specific and sector-specific assessments where countries find that actually the financial support and the guarantees that they provided to companies did not provide lifelines to zombie firms, but actually provided support to solvent firms. So there is not much evidence that on a systematic scale that we have seen slowing down allocation efficiency because of those interventions. At the same time, looking ahead, at the transformation of our economies that's ahead of us on the travel towards a more decarbonized economy, it's clear that this will go with the churning of firms. I mean, I think we have to also build a bit of a tolerance on this less friendly or less positive aspects.
Perfect, thanks a lot. Let me now turn the table to Jochen. Can you please share with us your reflection on the topic, but also the report in particular?
Sure. Thank you very much for the invitation. Congratulations to the report as well. I think I can take over directly where Reinhard stopped with the financing angle. Given that I'm coming from the EIB, maybe just two, 3 words on just for those who don't know, right? We are a development bank owned by the EU member states and invest mostly in projects that help growth, cohesion, with a strong view on supporting the green transition. Now, one thing, I mean, your presentation was incredibly compressed, so there's much more material in the paper, which I can only encourage people to read. But one element that happened to fall out of this presentation was your focus on reducing dispersion, which of course is the quantitatively most significant one, and that's also what we see in Europe when we look at specifically the EU context. But it's I think it's also worth just stepping back to the level argument, right, and say, look, we can increase growth by improving the quality of capital, by improving the quality of labor that's coming in, and also by promoting innovation. And as it happens to that, at least 2 of them is exactly what we are doing as well as a bank, right? Coming from the finance angle. So we provide risk capital, for example, to young companies. But we also, Reinhard, you mentioned the necessity to have good infrastructure, right? So we also provide funding for infrastructure. So via these mechanisms, I think we manage to lift growth. We finance schools, we finance university, help a bit skills, the development of skills this way, right? We also fund promising companies, particularly SMEs that are finance constrained, right? And this is where your dispersion, I think, comes in again, because these companies would not be able to grow, take up a larger part of their sector, being a more productive firm, if they didn't have access to finance. So there you could argue that the EIB not only tries to lift the level, but also tries to reduce the dispersion of growth and of TFP. One aspect I wanted to mention here is specifically on investment, and that relates to obviously to the quality of capital. So, and it comes to the policy implications as well. We run a pretty large survey among corporate firms, and ask them about their investment behavior and the obstacles to investment that they are facing. And there, apart from the conjunctural things, you know, I mean, obviously during the energy shock, people complained about high energy prices, right? That's not surprising. But the factors that keep popping up, aside from uncertainty, is skills, right? How do I find the staff that helps me implement the investments and then operate these new investments? So the development of skills is not only crucial just to make the factor labor, coming back to your framework now, more productive, but it's also absolutely important to allow corporates to make all those investments that are necessary at the moment, from my house's perspective now, in particular for the green transition. So working on these investment obstacles would be for me one of the main policy needs. And aside from skills and uncertainty, it's also regulation. And it's the perception of companies that administrative processes take too long. And that you have in particular with young companies who've got a single product in a fast changing market environment. They can't wait for a year, you know, for a decision. They need fast decisions also from us, right? Also from us, but also from other public authorities that influence their decisions, say permits that they need. They need fast decisions to be able to compete internationally as well. And that's of course something we want. We want these companies to be here. So, the fact that decisions need to be made fast still means they need to be made accurately, and that comes back to the shortage of skills. And there again, we've been running a survey this time among municipalities about their biggest investment obstacles. And there, aside from finance, it was really the lack of skills, right? We are lacking the engineers evaluating all the projects that we actually would like to evaluate. And so I think skills is something that when I think about these questions, return again and again. Thanks.
So if I can ask a follow-up question on that, because it's something I think sometimes when we think about skills, struggle a little bit. It's like the problem of subsidiarity in many of these questions, that at one level, I think there's a general recognition that skills is one of the key obstacles that you face. At the same time, it's also something that is often very located at very low level of governance, or low in the sense of at municipalities, at the member states. And we see similar in these administrative procedures that they are different by member states. There are a lot of reports being written on how to improve them, especially the single market, by improving these administrative procedures, which often are then not in the hand of the EU. So for you at the EIB, what are things that EU-level policymakers, but also national policymakers could do to make your job a little more easy and the job of your clients in navigating these things? What are the right levers that could be done?
So I think because we finance relatively I don't know whether now the micro is back. So we finance relatively few projects, but relatively large projects, right? So they do have the idiosyncrasies, and we do cooperate with very good people on the other side, right? But if you look at surveys, I think what you notice is that naturally, the national administrations, the central part of national administrations often attracts. Maybe they are in the nicer cities, maybe they just attract a larger part of the really motivated and good and highly qualified public administrations. And that leads to a natural selection mechanism, But I mean, I can't report this from personal experience, but when you run surveys about what administrations need most, then it is often in the municipalities where you encounter the largest skill gaps, and they're very transparent about it, right? And there are technical assistance programs helping them with it, for example, by the European Union.
Okay, perfect. Thanks a lot. At this point, I will want to bring Nan back into discussions, so give her the opportunity to respond to all the things that these many different aspects on the debate we just heard about.
Yeah, great. I think it is really fascinating to be here to hear about the European perspective and experiences. I think I'm just gonna pick up a few topics that I think are really important, even putting in the context of the analysis we did in the chapter. So one thing you mentioned is this financial market integration, a deepening of financial market. What we saw in this, when we're looking at the misallocation or increasing misallocation, a lot of it comes from what we say size-dependent frictions or regulations or policies. By that, what we mean is, give you some example. I think in Europe, I'm not sure in Europe this is prevalent, but in a lot of emerging markets, you have those regulations that once the firm grow beyond certain threshold, then there will be certain extra regulation, requirement, restriction, and tax. So firms are artificially small by choice because they don't want to step into that area. So, and that prevents the firm from taking advantage of economy of scale to size up. And equally important, similarly, is the access to finance has the same role. If you are a small company but have great idea, but the financial constraint is kind of size dependent. In a sense, the smaller you are less likely to have collateral. Or you are banking heavy system, not a capital market heavy economy, then you may not have the opportunity to scale up by having the financing. So those are all potential, more realistic examples of sources of misallocation. Although we didn't study that, deeply in the chapter because it has so much going on, but I think that's a potential area really worth thinking about. So that's my first point. Another thing I want to touch upon is skills, and I think this is also really interesting, comparing just based on casual observation between Europe and the US. In US, you see a lot of industry, university kind of agglomeration, right? You think about Bay Area, Berkeley, Stanford, with all the big IT companies. And I think this is maybe, again, matter of skill or something else. We don't see that much in Europe. So that is one thing I think worth pondering why and what is the value of that, and if that is something maybe policy can also foster. Another thing is about talent allocation. It's my personal new passion to think about when we are in this aging society, you're just going to have less and less working age population workers. Getting people into the labor force, it is one way to do, but there is a limit. There's just so much you can do to get. We already saw a lot of women getting into the labor force and the increasing growth in the past. We have, older workers in Europe also participate more actively in the labor market, but eventually you're gonna face some limits there. So what is the way out? I think it's about having a better match of the skills with the job. So given the number of people, but allocate people better. And here, based on just, again, this is something we are currently under research, but we have research coming from the US based on US experience. This is a very influential paper by Xian Clino, Eric Hurst, Chad Jones, and Pete Clino. When they look at the past 5 decades in the US, in 60s, 90% of the job, a high-skilled job, that is manager, doctor, lawyer, are occupied by white male. And now in 2000s, you have only 60%. Of course, it's still not 50-50, but it is a good movement. And that trend, when they do the estimation using structural model, they find that trend actually contributed 0.5% per year annual growth, which is really sizable if you think about it. So if we see a big gap there for particularly emerging markets. I'm sure we also see gap in Europe as well. If you can move in that direction and closing some of the gap, having better allocation of talent, not by social norm, not by discrimination of gender or race, maybe there is another area that can have a lot of gain. The last thing I think I have mentioned also is about kind of touch upon this capital market and the innovation. And this is, I'm pointing to that because the chapter has not talked too much about it, but I think it's really also very important. We didn't talk about it because there is a pre-existing, a lot of extensive research. Innovation really is the key for the long run. And when we have aging society, we have less researchers, less ideas. I think this is really an area that's worth more thinking. And for Europe, I think the capital market integration you mentioned, I think that is really the key, right? Because you need this kind of funding sources that are willing to take risk, not banks, which have faced all kind of risk regulation. So you need more venture capital. You need more capital market integration, so to speak, to foster innovation. So let me just stop there and pass on back to you, Nicola.
Thank you. I don't know if there's already questions here in the room. Yeah, we already have one, so let's maybe give the floor to our guest. Please, if you can give the microphone.
Thank you very much. It's on? Yeah. Thank you very much. No, I had two questions.
Can you introduce yourself?
José González Mínguez, Banco de España. No, I have two questions on your presentation only. So one of them, you mentioned in passing that allocative efficiency is related to such factors as product market regulations or barriers, trade, also finance, international finance, no? And this, or the availability of finance, no? This sort of factors, no? So the question is whether you have done actually you have done any attempt to empirically try to test the relative relevance of these factors, no? And the second issue refers to the period going forward, no? So recently, allocative efficiency has had this negative contribution to TFP growth. No? Actually, going forward, if I got it right, because actually, well, you showed the slide quite fast, no? Because you didn't have much time. But actually, if I saw it correctly, going forward, actually, the contribution of TFP to growth does not diminish much compared to the past. No? While perhaps there are good reasons to think that allocative efficiency should get even worse in the future. No? I mean, with deglobalization and this sort of trends which point in the direction of trade barriers and so on. This point in the direction to worse allocative efficiency. You know? And on the other hand, there is, if I saw it correctly, quite a sharp decrease in the contribution of capital. So I wonder whether you could explain to us what assumptions are in this baseline, not in the alternative scenarios, but in the baseline going forward, which assumptions explain that this contribution of capital decreases so much, and on the contrary, not the contribution of TFP. Thank you very much.
Thanks a lot for that question. I'm not sure if there are other questions. Maybe we can collect a few. I see one back there. Could you give the mic to the gentleman in the second row?
Should I stand up or? Okay. Okay. Thomas Muller-Nilsson at Euractiv. We actually spoken over the phone. I have a question about the role of security in all of this. I mean, I think you sort of alluded to it in your presentation when you discussed economic fragmentation. But I'm reminded of this comment that Christine Lagarde made at Davos, where she said, look, countries these days are they're faced with a kind of binary choice between security and economic efficiency, and a lot of them are opting for security. So I was wondering what role that played in hampering global growth. Thank you.
Thanks a lot. I don't see another question in the room, but we have two online. Basically, one is on migration, which I think is something we definitely have to talk about. It's basically what are the margins that we have through basically to challenge the problem that we have with demographics through the extensive margin of migration. And the second one is basically to which extent should the EU basically take on, the way I understand the question is to take on debt to basically finance for the public purse some of this lack of investment that we have in the private sector. So I give Nanda the stage first, and then we can go to the other two panelists so everyone has the chance to answer the question they would like to focus on.
Great. Can I choose which questions? I'm leaving more the politically charging question to our panelists.
The easy ones
Okay, so let me start with just in order of being asked. So the question about evidence on labor and the product market liberalization. There are, in the literature, there are a lot of studies, and most of them are based on specific country cases, and sometimes it's a structural model, because that is the framework that can run real counterfactual, assuming something did not happen and everything else hold equal, because empirically, it's really hard to document the effect of policies, especially when they don't really change that much. So somehow you opt for like event study approach, you usually do find evidence. And I think most convincingly, usually it's in the evidence about financial, the improvement in the financial market, the role of reducing misallocation. I think that we see more consensus. The structural labor and the product market, internally in IMF, we have a lot of studies, different approaches, also seems to suggest evidence very much aligned with what we're talking about here. Your question on medium term, which is a very good question. So starting with the misallocation component, your understanding is exactly correct. The reason it didn't deteriorate, TFP didn't deteriorate in the medium term as much as recently is because the misallocation component will become a less drag in the medium term because a lot of it has already happened. And as I mentioned, with the assumption that there's no additional shock, there's no additional structural shift, then the misallocation kind of self-corrects, so revert to the long-run level because firms with time take time to overcome the adjustment frictions and the cost. So that explains that. The capital part, the way we do it is to rely on our analysis of investment and growth relationship. So when you expect less slowdown in TFP growth, you expect labor contribution will slow down. That will tell you your marginal rate of return for capital is going to be lower, so your capital will endogenous to the other assumption of the forecast. So that is how it happens. In terms of efficiency issues, this is the other question. Can you remind me just quickly again? Oh, right. So I think that is often an issue in the context of industry policy. I guess that's what you want to ask. I think security and resilience is the two well-cited call for industry policy. There are some truth in it. Of course, this kind of industry policy is also very different from the traditional industry policy back in 60s and 70s when developing country trying to develop like the China story, right? So I do think there is this tension here. There is security, especially there's energy security. You want to secure the kind of the commodity, the key mineral for your energy transition. You also want to secure chips, and that is, we have seen a lot happening in US. The efficiency part, I think we understand a little bit better. And we have recent fiscal monitor chapter, which is coming from the Fiscal Affairs Department of IMF. They did a very thorough study on industry policy, specifically when the government pick which sector to invest R&D. And then there, I think the conclusion is we need to be more careful because that kind of industry policy can potentially be a source of distortion.
If I may ask, we got one follow-up question that basically goes in a similar direction from my colleague Marek, which basically asked directly on this, do you see in the productivity data any effect of protectionism yet, or is this something that is maybe not possible to filter out or more for the future?
Yeah, this is definitely more for the future. I mean, the allocated efficiency we did, it's about within country, within sector, cross-firm allocated efficiency. And you can say it has something to do with cross-border flow of knowledge, idea, and goods. But that is not in the framework that we're using. But that said, I remember clearly if want to forget about causality, but if you just look at the FDI to GDP ratio globally, and there is a clear trend before the global financial crisis, it goes up and then slow down. And if you just look at the correlation of that with the labor productivity in emerging market developing countries, the correlation is really strong and with the elasticity about 0.6. So that is another thing to say, if you worry about geopolitical fragmentation and the slow mobilization, there is another margin that's going to affect, which is the knowledge flow and the productivity growth. Yes.
Thank you.
Thank you.
Jochen, do you want to come in on some of these questions?
I mean, maybe I can also follow up on the security versus efficiency. I don't think it's really a binary choice, right? There are many different steps in between. I think there's always, from an efficiency perspective, there's always a good case to be made for diversifying your supplies, for example, worldwide, keep up a good relationship with the largest number of possible countries. And then, as it's also current DC policy at the moment, really try only in the extreme cases where you think it's absolutely necessary that you have a certain product and that it's absolutely needed to foster that industry now, then try to do it yourself, right? Because the losses in terms of gain, the losses from not trading are so huge, right? That you wouldn't want to do this only with the exception of those circumstances where you're really absolutely sure that you need to capitalize in order to ensure your security. So for me it's a continuum. And then I'm actually happy to pick the immigration question. I mean, we don't. I mean, as an economist, particularly working for a European-owned investment bank, I can't comment on the policy dimension, right? But what I can say is what the contributions of immigrants to economic growth are, right? And there, for example, if I just look at one specific case of the large immigration, in relative terms, large immigration of Ukrainians over the past years, if I look at some of the Eastern European countries that received a particularly large proportion of that immigration relative to their own population, the additional benefit that these economies had in terms of their GDP is at about the same order of magnitude as the direct costs that often make it to the press in terms of benefits and so on, right? So I think, and maybe that's a political angle, one needs to emphasize those positive aspects as well, and then perhaps it will make it easier, right, to accommodate immigration. And I mean, Nan, maybe you have got from a growth statistic point something to add.
So, exactly. When we look at the U.S., the recent 3 years experience during and after the pandemic, there was a large immigration, and most of this are actually illegal immigration, so cross the border, and I think contributed to about 1% labor force in U.S. And the CBO has some estimation. I mean, I'm just citing vaguely. I remember in the medium term, if this trend continues and also the immigrants slowly get successfully integrated into the labor force, that can contribute about 0.2% of growth, and that is, again, quite sizable. So there are, if just purely talking about number, right, and with some reasonable assumption about integration, we do see there are convincing evidence suggesting this is a good force. But of course, there is consideration of domestic job lost and, you know, what it means for other labor adjustment program. And I think those are really important question we need to do more work on.
Thanks. Let at this point get back to Reinhard so you can.
Maybe a quick word on this thorny issue as well. I mean, there's obviously, I mean, it's politically a very difficult territory, not only in Europe, obviously, and there is somewhere, but it's not an exact science, probably some social acceptability tolerance. But this is something I think we're also in terms of explanation, what you said, Jochen, to explain, and this is what we're also will be trying to do with our forecast, to show that immigration has actually a positive impact on growth. By the way, obviously also for the sustainability of public finances. I mean, we published our aging report, I think last week. But this is also an element. But we should also be clear, it's not the solution, and that may be, I mean, just to be, get the basic facts right. It can help absorb some of the demographic effects, but not all, by no means. And certainly we need to invest the politics in the political economy of that in order to make the explanations. But I felt compelled as a colleague from DG ECFIN to pick up on the fiscal issue, also in light of the fact that the new fiscal rules in Europe came into force last week. Now, maybe first a more general remark. I think for the long-term growth, there was no correlation between high debt and growth performance. I mean, that's just as a starter. And overall sustainability of public finances are, in our view, a key ingredient for an overall economic framework that is, conducive to private investment and so forth. And we have seen in the past, if due to excessively high levels of debt, risk premiums go up, there is a high correlation with the rest of the financing of investment in the same country. So this is not an easy solution. This having said, when negotiating and when discussing the reforms of the fiscal rules in Europe, we were very aware and drew lessons from the experience of the global financial crisis, when the cutting of public investment was like the first culprit in the context of sometimes very pro-cyclical consolidation strategies. So defending and protecting public investment in the consolidation strategies of member states, that is an important element of the reformed fiscal rules. So just to, and I stop in a second, but just for the detail for the member states who are in autumn are obliged to submit their medium-term fiscal plans. They can have a more extended, therefore more gradual adjustment path subject also to important public investment that they're undertaking. So that's an important element. And by the way, in Europe, at least for another couple of years, with the financial support provided by the RF, I mentioned it already, there is also some additional complementary support to uphold public investment despite embarking on national consolidation strategies.
Thanks a lot. Unfortunately, running out of time. So, I mean, I have many follow-up questions, but we have to wrap up. So, I maybe want to end with like a Bruegel. We like to be hopeful. So, let's end with a kind of a positive message here. So, I want to ask all of you, what are things that make you hopeful that we avoid Eurosclerosis 2.0 or anything of the sort? What are the policy levers that you think we're focusing rightly on that could change the picture? What are things maybe that make you less hopeful and we should work on to make you hopeful? If I may start with you, Reinhard, in reverse order now. Yeah.
Okay, very quickly, I think a couple of points are now coming together that make people understand. It's maybe not so positive, I'm afraid. I mean, we have geopolitical tensions in Europe that require more and more joint action. We have huge uncertainty coming out of the US with a view to the presidential elections. And no matter what the outcome is, I think it also has driven home the message that Europe has to get its act together. This is a bit of the sense that I'm getting. This is where I get, I'm a natural optimist. So where I'm also getting, hopeful at the beginning of this May.
Thanks a lot. Jochen, what makes you hopeful?
Well, I'm picking the green transition, even though there's a lot of debate around it, but I think it energizes a lot of people, and there's a lot of movement behind it at the policy and at the personal level, I think, as well. I think the transition itself is triggering a lot of innovation, and it's actually an area of innovation where the EU is also leading, right? It's not the usual picture where it's the US that is leading R&D spending and innovation, and it's China that is catching up from lower, but now not anymore lower levels at all. But it's really Europe that is still leading there. And so I think this is really an area where we can build a comparative advantage here in Europe. And what we need to do is to get the investment conditions right for that.
Thanks. And then let's go to you. And maybe I can give you a slightly different version of the same question, because this is the World Economic Outlook. I mean, I would be happy to hear from you also what you think about the European economy, but maybe since we kind of didn't really have the chance to talk about the global outlook, how do you feel the picture could be shifted more positively in the coming years?
Yeah, so for me, I think it really is what make me feel hopeful. On the policy side, I feel like countries now have more at least consensus on certain issues are important and we need to join force. And also on the technology side, it's really exciting what AI can bring, although there's also pessimism about, the downside AI the negative impact it can have. But I think the upside is extremely large, and we still just, at the beginning of this transformation. So I'm very excited to see what's going to happen in the next 5 years. And of course, the policymakers can foster this process, can harness this, think about how to best harness the benefit. But for me, what I worry is really this increasing emerging risk of geopolitical fragmentation. And I think I worry about it, especially this is the time we need to do things together in terms of AI regulation, in terms of green transition. I mean, all those natural forces coming to us, and if we have a fragmented world and political system, and I think there are big risk and danger there.
Thanks a lot. I think we're out of time, but thank you so much for this panel and for the audience. I think we have many more sessions we will have on this topic to understand it on the academic side, but also, of course, on the policy side, what can be done. Thank you all very much. I think the real conclusion of this debate is read the World Economic Outlook, and especially Chapter 3 that was written by Nan and her colleagues. And let's all join me in an applause for the panel. Thank you.